Imagine waking up tomorrow and discovering that money no longer exists. No cash, no bank accounts, no digital payments. How would you buy food, pay rent, or get paid for your work? Money is so deeply embedded in our daily lives that we rarely stop to think about what it actually is, where it came from, or how it works. In this video, we'll explore the complete story of money, from its origins in ancient trade, to modern banking, inflation, debt, and how you can manage money wisely. By the end, you'll understand not just how to use money, but how the entire financial system operates. Part 1. Life before money, barter and its problems. Thousands of years ago, money didn't exist. People traded goods and services directly in a system called barter. A farmer might trade wheat for tools, or a shepherd might exchange sheep for pottery. While barter sounds simple, it had major limitations. The biggest problem was something economists call the double coincidence of wants. For a trade to happen, both people had to want exactly what the other person was offering at the same time. For example, if you had apples and wanted shoes, you needed to find a shoemaker who also wanted apples. If they didn't, trade couldn't happen. Barter also made it difficult to measure value. How many apples equal one pair of shoes? 10? 50? The lack of a common standard made trade inefficient and limited economic growth. Part 2. The birth of money. To solve the problems of barter, societies began using items that everyone accepted as payment. Early forms of money included shells, salt, livestock, and metal objects. Over time, metals such as gold and silver became the most popular forms of money. They were durable, portable, divisible, and relatively scarce, all important properties of good money. Eventually, governments began minting coins with standardized weights and symbols. These coins made trade easier because people trusted their value. This marked the beginning of official currency. Money, at its core, serves three main purposes. A medium of exchange, it allows people to buy and sell goods easily. A unit of account, it provides a standard way to measure value. A store of value, it allows people to save wealth for the future. Part 3. From gold to paper money. Carrying gold coins was not always convenient or safe. To solve this, people began depositing their gold in secure places, such as early banks or goldsmiths, and received paper receipts in return. These receipts could then be used in trade instead of the physical gold. Over time, people realized they rarely needed to withdraw the gold itself. The paper receipts became accepted as money on their own. This is how paper currency was born. At first, paper money was backed by gold, meaning that every banknote could be exchanged for a certain amount of gold. This system was known as the gold standard. However, most countries eventually abandoned the gold standard and moved to fiat money. Fiat money has value not because it is backed by gold, but because governments declare it to be legal tender and people trust that others will accept it. Part 4. How modern money exists. Digital and bank money. Today, most money does not exist as physical cash. The majority of money exists digitally in bank accounts. When you check your balance in a banking app, you are looking at numbers in a database, not stacks of cash in a vault. Banks play a central role in creating money through a system called fractional reserve banking. When you deposit money in a bank, the bank keeps a small percentage in reserve and lends the rest to other people. For example, if you deposit $1,000 and the reserve requirement is 10%, the bank keeps $100 and can lend out $900. That $900 may be deposited into another bank, which then lends out $810, and so on. This process effectively increases the total amount of money in the economy. Part 5. What banks actually do. Banks perform several critical functions in the economy. They store money safely, making it easier for individuals and businesses to protect their wealth. They provide payment systems, allowing people to transfer money electronically using cards, online banking, or mobile apps. And they issue loans, which allow individuals and businesses to spend money they do not currently have. Banks earn money primarily through interest. They pay depositors a small amount of interest for storing money, and they charge borrowers a higher interest rate for loans. The difference between these rates is part of how banks make profit. Central banks, such as the Federal Reserve in the United States or the European Central Bank in Europe, oversee the banking system. They control the supply of money, set interest rates, and act as lenders of last resort during financial crises. Part 6. How inflation works. Inflation is the gradual increase in prices over time. When inflation occurs, each unit of money buys fewer goods and services than before. For example, if a loaf of bread costs $1 today and $1.10 next year, that is inflation. Your money has lost some of its purchasing power. Inflation happens for several reasons. One major cause is an increase in the money supply. If more money is circulating in the economy but the number of goods stays the same, prices tend to rise. Another cause is rising production costs, such as higher wages or more expensive raw materials. Businesses often pass these costs on to consumers in the form of higher prices. Moderate inflation is considered normal and even healthy for an economy. However, very high inflation can be damaging because it makes saving difficult and creates economic uncertainty. Part 7. Saving and the time value of money. Saving means setting aside part of your income for future use. But money today is worth more than the same amount in the future. This concept is called the time value of money. If you save money in a bank account or invest it, you can earn interest. Interest is essentially the cost of borrowing money or the reward for lending it. For example, if you deposit $1,000 in a bank account with 5% annual interest, you will have $1,050 after 1 year. Over time, this can grow even more through compound interest, where you earn interest not only on your original money but also on the interest you already earned. Saving helps protect you from emergencies, allows you to make large purchases in the future, and reduces the need to take on debt. Part 8. What debt really means. Debt is money that you borrow with the promise to pay it back later, usually with interest. Debt is not inherently bad. In fact, it plays a crucial role in economic growth. Individuals take on debt to buy homes, pay for education, or start businesses. Companies borrow money to invest in equipment, research, and expansion. Governments issue debt in the form of bonds to fund public projects and services. However, debt becomes dangerous when borrowers take on more than they can realistically repay. High levels of debt can lead to financial stress, bankruptcy, or economic crises. Understanding debt means understanding interest rates, repayment schedules, and the total cost of borrowing over time. Part 9. Digital payments, credit cards, and the future of money. Today, many people rarely use cash. Instead, they rely on debit cards, credit cards, online banking, and mobile payments. These systems allow money to move around the world in seconds. Credit cards are essentially short-term loans. When you pay with a credit card, the bank pays the merchant on your behalf, and you repay the bank later. If you don't pay in full, interest is charged on the remaining balance. In recent years, new forms of money such as cryptocurrencies and digital currencies issued by central banks have begun to emerge. These technologies aim to make payments faster, cheaper, and more secure, but they also introduce new risks and challenges. Part 10. Why understanding money matters. Money affects nearly every decision we make, from where we live to what career we choose. Yet many people go through life without ever learning how money truly works. Understanding money helps you avoid scams, make better financial decisions, and plan for the future. It also helps you understand the news, economic crises, and government policies that impact your daily life. That's a wrap on how the money really works. Now you know the magic behind every cent. If you enjoyed this, hit like, subscribe for more eye-opening tech breakdowns, and drop a comment on what to unpack next. See you in the next one.